Before retirement, your cash flow is dictated by a paycheck. At retirement, that paycheck is gone. The stability of that steady stream isn't there anymore, and that can be a daunting thought. Now, it's your responsibility to decide where your income is coming from. So today, we'll walk through the steps we use to determine the best order of income for our clients during retirement. Making smart decisions on where money is pulled from could create tax savings, which will ultimately put more money into your pocket and help you better achieve your financial goals. The first step in this process is understanding what fixed income sources you have. This could be from annuities, rental income, a company pension, or Social Security. This is your baseline income. Income that is coming in no matter how you're invested and that you don't really have to do anything for. The reason we start here is because we want to calculate our income gap. This is taking your desired income or retirement spending goal and subtracting all your fixed income sources. The result is the income gap we're trying to fill with the other sources you have, such as brokerage accounts, 401ks, and IRAs. So let's assume you want $10,000 per month in retirement income. Between you and your spouse, you're going to receive $6,000 per month in Social Security. This leaves a shortfall or income gap of $4,000 per month or $48,000 per year. This $4,000 per month or $48,000 per year is what must come from your portfolio. Once you understand your gap, then you must understand what types of accounts your portfolio has. Here there are three main types. One is taxable accounts. These are your brokerage accounts, could be trust accounts or individual accounts. Accounts you are taxed on every year in the form of dividends, interest, or gains if you sell. Two is tax-deferred accounts. These are your traditional IRAs, 401ks, or annuities. These accounts aren't taxed now, but are taxed when you make distributions. Three is tax-free accounts. These are Roth IRAs and Roth 401ks. This is money that you pay tax on now, but when you pull money out later, there are no taxes owed. The traditional way of thinking, the way that most our clients come to us thinking, is that I want to spend the taxable accounts first, saving the tax-deferred and the tax-free accounts for later, with the idea that we will take less or won't be in such a high tax bracket as we get older. Then we spend down the tax-deferred accounts and finally save the tax-free Roth accounts for last. Let them grow the longest. Now there is some truth to this thinking, but the problem is that you're thinking about immediate tax rates and rate buckets. You can have low taxes now using the taxable accounts, higher taxes in the middle using tax-deferred accounts, and lower to no taxes in the end using the tax-free accounts. But the flaw in this line of thinking is about taxes overall. How can we minimize taxes over the course of your retirement and not just year by year? This is the main focus for us when we do a retirement financial plan for clients. We may pay a little more in taxes in some years, a little less in others, but overall, through the course of your retirement lifetime, what's our overall strategy to minimize total taxes paid across all those years? So we want to look at this from an approach of overall tax brackets. One advantage of retirement income and creating your paycheck is you get to determine your tax brackets. So let's use the example from above. You want $10,000 per month of income. You and your spouse's gross Social Security is $72,000 per year or $6,000 per month. With just this, we see that your total taxable income is $2,000. This is because the IRS taxes Social Security based on the concept of provisional income. Provisional income takes your gross income and 50% of your Social Security benefits. If that number is less than $32,000 for joint filers, then 0% of Social Security is taxed. If provisional income is between $32,000 and $44,000, then 50% of it is taxed, and greater than $44,000, up to 85% is taxed. In this example, there is zero gross income and one half of the Social Security benefit is $36,000. The first $32,000 is not taxable, and of the difference of $4,000, $2,000 is taxable. Why is this important? You can see here that ordinary income up to $23,850 for 2025 is taxed at 10%, and it goes up from there. For a 65-year-old married couple, the standard deduction is $33,200. So the first $33,200 of income nets zero taxable income because of the standard deduction. But let's look at the brackets. Taxable income below $96,950 for 2025 is taxed at 12%, and taxable income above $96,950 is taxed at 22%. That's a substantial increase. In some cases, it might make sense to take advantage of the 12% bracket before we jump to the 22% bracket. Now, most people think they will take the $4,000 per month or $48,000 per year income gap from the taxable account and pay little or no taxes. Let's take a look at that. If we assume that of the $48,000 we take from our portfolio, and of that, let's assume that 50% or $24,000 is considered capital gains, then according to our tax report, we are paying zero in taxes to generate our $10,000 per month paycheck. This is because of our low taxable income of $10,400, 0% of capital gains are taxed. Sounds good, right? Yes, for the short term, but not necessarily for the long term. Why? Required minimum distributions. RMDs are a required withdrawal amount at age 73 based on account values and an age divisor. Whether you need the income to fill the gap or not, the IRS doesn't care. The distribution is required. I've seen many cases where the RMD is greater than the need, but we have to take it out and we have to pay taxes on it. This could throw you into a higher tax bracket. So what can we do about that now? Take advantage of the tax brackets. We already discussed how there is a substantial bracket increase from 12% to 22% depending on taxable income. So maybe we decide to fill the 10% or even up to the 12% bracket. All right, so how can we do this? Let's look at maybe taking some from multiple account types. Maybe we take some of the gap from the tax deferred or IRA bucket and maybe some from the taxable account bucket. Let's run the same assumption as above. $10,000 per month need or $120,000 per year. $6,000 per month or $72,000 per year income from Social Security. Now, instead of taking the $4,000 per month or $48,000 per year gap from the taxable account, let's take $20,000 from the tax deferred and $28,000 from the taxable account. You can see that we're actually filling the 10% bracket to within about $2,000. Tax due is in the 10% bracket, but averages 3.5% of total income. Now, where are you going to beat a 3.5% average income rate? And what this does is it starts to smartly spin down the tax deferred accounts so that at 73, the RMDs we are required to take could be more advantageous for your income and tax need. We could even look at filling the 12% bracket. We could do this a couple of ways. We could take the entire $4,000 per month or $48,000 per year need from the tax deferred accounts. This begins to fill the 12% tax bracket, but you can see that we're almost $65,000 less than the income threshold. We could look at the same combination as before, taking $20,000 from tax deferred and $28,000 from a taxable account, but now let's fill the 12% bracket with a Roth conversion. Let's convert $41,500. You can see we've essentially filled the 12% tax bracket. Now there are 1,000,001 ways to fill this bracket. By that, I mean 1,000,001 combinations of tax-deferred, taxable, or tax-free assets to fill this bracket. All this to say that where you pull funds from in retirement isn't necessarily an investment decision as much as it's a tax bracket decision. Here's the 4 things I want you to remember from this video. 1, let your Roth IRAs work as long as possible. 2, no required minimum distributions. 3rd, understand Social Security taxes. Last, and one thing we won't spend too much time on today, is IRMAA surcharges. This is a surcharge on Medicare premiums if income is above certain amounts. Medicare B and D charge monthly premiums, and if your modified adjusted gross income is above $212,000 for married joint filers, a surcharge applies. As we run these analyses for clients, this is definitely something we look at when making recommendations for where to pull retirement income. All this to say, there are many things to look at when deciding your retirement income strategy. Not only short-term impacts, but intermediate and long-term impacts as well. And the best way to cover all these bases is with a comprehensive retirement plan that not only looks at allocation and goals, but tax strategies. As viewers of our YouTube content, we're offering complimentary one-on-one strategy sessions to those who reach out by phone or email. So give us a call or shoot us an email and we'll talk to you soon.